23,946 is where we're at. Oh, yeah. Rashi Talwar is joining us now, partner and portfolio manager at Ashmore. Rashi, good to have you with us here, and thanks very much for joining us. You're joining us on an interesting day. It's we're sort of winding down the year, and we thought that we'll sort of do this nicely without too much volatility, but volatility we have got. So I just want to start by asking you whether you think this is the start of a bit of a correction in global markets, or you think this is going to pass. We had a few gentlemen in the morning, early morning with us, who Ed Yardini and others, who thought that this could be like a 10-15% kind of a pullback in the US. But if that were to come true, I mean, it's unlikely other markets will not feel the pain. So just your thoughts, Rashi.
So, Prashant, we're sitting at all-time high multiples for parts of the market, right? And specifically in the mid and the small cap space. When you are sitting at all-time high multiples, I mean, the mid cap is about 38.5 times 1 year forward. The small cap is also pretty high. The point is, and we're starting to see earnings growth slow down. I don't think there is any debate with that. And the next 2 to 3 quarters will continue to see earnings growth slow down. The way operating leverage works for companies is that the smaller and the mid-cap companies see much higher operating leverage on the way up when earnings are improving and commodities are coming down, because as a percentage of their raw material cost, etc., commodities are a much higher percentage, etc., all sorts of operating leverage. But it happens the same way on the way down when negative leverage starts to play out. But at the same time, nobody's really gone ahead and cut their earnings growth estimates for a lot of the small and the mid-cap companies. The point I'm trying to make in short is really that I think there is more pain ahead. I think the pain is specifically in the small and mid-cap space, because right now you're sitting at all-time high valuations. You're sitting at earnings growth, which is starting to move down, and people haven't readjusted their estimates and the numbers to that reality. Sometimes it just takes something on the external environment for people to wake up and figure that out, and whether that is the Fed deciding that they will not cut as much as people had thought they would. Maybe. I can't tell you that, but that's clearly to me what seems to be happening.
So Rashi, fresh money allocation. Clearly your bias is towards large caps, but you want to provide some more color on the kind of themes that you prefer going into next year. What would be the top ideas?
So, our top ideas, like you said, very accurately, yes, we are far more large cap heavy today than we've been historically, and that will continue in the large cap space. In financials, it's the large private sector banks. We do believe the smaller ones and the NBFCs are going to have their share of issues going ahead. It's already visible and will continue. Pharma is a very big bet for us, and the large pharma space companies, the hospital space as well. So that's a big bet for us. On the tech space, we believe expectations are reasonably beaten down, and as order flow comes through and as you start to see those numbers come through, that's a space that is actually pretty well positioned as well. So that's how we are positioned. We do have some of our unique bottom-up ideas, as always, and those continue, and those are reasonably sector agnostic as terms of the way you're looking at it. But that's the color of how we're positioned, and I think I'm going to run that for a bit. There needs to be some serious correction on the small and mid space for me to want to start to reallocating the portfolio back into that space.
All right. Hi, Rashi. Good afternoon. Good to see you in. This is Nigel on this side. Rashi, I want to ask you about the consumer staples. Some very, very high pedigree companies. Y'all are relatively underweight over there. Hence the time that y'all are going to turn that stance. I mean, what are the triggers y'all are looking for? Because y'all are, if I look at it in comparison to the benchmark, y'all are very underweight on that space.
Yeah, so we are. When you look at the large consumer staple companies and they're trading at 45, 50 times earnings and giving you mid-single digit earnings growth, it doesn't cut it as far as we're concerned. We do have one staple company, don't want to name it, but we got it at an opportune time, and it was relatively dependent on the rural economy for its products, etc. And we got it at a time where valuations were attractive, and then after that, rural economy seems to have come back. We do have a bunch of the discretionary stuff, which we feel helps us offset what we don't own on the staple space. And we feel those ideas gave us more opportune times to enter into those stocks and play the rural recovery of demand that we are looking to see.
Got that, Rashi. Yesterday we had a market town hall, and we had 3 mutual funds CIOs with us, and we were trying to get some ideas, right? Pockets or buckets to look in, and micro themes, not the larger conventional themes. And there are so many now which are there, and they're not small exactly. It's not as if they're undiscovered or anything. Actually, if anything, most of these are richly valued, but these are faster growing segments of the market. So as we head into 25, you want to sort of lay out 1 or 2 themes, or just pockets where one should look for ideas in, which are differentiated, which can make one money.
So, like I said, I think if you look at some specific rural recovery stories, I think they're still not priced in fully. And I think that space on the consumption side is starting to see some recovery after quite a while. So there's a catch up of demand that we're expecting to happen. And that is part of what how we're positioned as well. I like the hospital space as well, and I think that has opportunity there with a lot of stocks looking attractive, or at least what we own is looking reasonably attractive in that space as well. Large cap financials, they've done private sector banks. They've done nothing for the longest time, and in a tough environment, in a tough operating environment, where credit costs on unsecured loans and credit cards, etc., starting to inch up, these guys know how to maneuver that field. They're experts at it, right? So you don't see the same kind of hiccups with them than you do with the smaller guys. And I think they continue to have the levers to navigate this environment, and they also have when they come down to fight for deposits on the ground, they make it tough for everybody else. So that's a bet I would continue with as well.
And rural recovery, just narrow it down one level more, one level closer. What exactly?
So you can look at some of the rural recovery on the staple side, whether you're looking at hair oils, where you can look at rural recovery on the auto side. I don't need to go down where over there. It's indicative enough. There are enough rural recovery plays on that front. Another place, actually one of the only sectors on the NBFC side, which I think in this environment does really well, is gold financing.
Okay.
Because when you have unsecured credit, which has become very difficult and tight for in terms of credit growth, when will somebody go out and hypothecate their gold? They're not going to do it if they're getting easy personal loans and easy unsecured loans.
Yeah, no, absolutely. And stocks there have done well. Muthoot, Manappuram, I reckon you're talking about names like Bajaj Healthcare and the hair oil companies, and maybe two-wheelers, and of course hospitals is pretty obvious. Pharma.
You're smart enough for that, yeah. You know what I'm talking about, so it's okay.
No, I'm just, for our viewers, just to, indicate.
Life insurance as well. I think life insurance is another sector which has been reasonably left for dead, and I see that coming back pretty strong as well. So yeah, I think that's...
Have you seen our stories on life insurance? We've broken pretty much every one of them. And it's all, the regulatory environment has been in a bit of a turmoil over the last 2 years, and there is a lot changing. And I think that's the reason why stocks have not done well. So I don't know how that plays out. Maybe stocks have come into the value zone.
So, Prashant, that's exactly the point, right? I mean, we discussed this actually on your the Diwali special, that we pick stocks when there is some headwind to the sector, something that's going wrong. That's when you get them at the price that you're looking to get them at, right? Really good businesses going through something difficult. The regulatory environment, you're absolutely right, has been extremely tough for them over the last 24 months. But it's not the same for each company. It will play out in a very different manner for each company, depending on how they are structured, how their book is, how their distribution is, etc. Right? Everybody is not the same. So then that's our job to sit and figure which one of them is actually extremely attractive, and there are more than one. So that's part of the job.
No, absolutely it is. And we wish you the best of luck with that. Ritika, Rashi, thank you very much for joining us. It's a pleasure having you here on the program. And if you're sort of off on leave, happy holidays. Enjoy.
Thank you, Prashant, and Merry Christmas to all of you. And a Happy New Year.
And your team. And see you in the new year. Thank you very much. So that is Rashi from Ashmore with thoughts and some sort of ideas to ponder over. The last one was life insurance.